Not even 10 years ago, it seemed unfathomable that people like the Walt Disney Company and Netflix would one day be considered rivals. But that's just what Bob Iger did to Disney once it announced that they were going to go into the streaming space. Since then, Netflix has exploded, and Disney has, even though it had a temporary peak back about 3 years ago, has really been relatively stagnant, at least insofar as Wall Street sentiment is concerned. And now Netflix is worth about twice as much as the Walt Disney Company without any of the extras that the Walt Disney Company carries besides Disney Plus. And after Netflix's earnings call just about a week ago that we covered live here for the Renegade Nation, a lot of things are coming into much clearer perspective just to see how bad things are at Disney compared to Netflix, and what Netflix may be about to do to Disney in the next couple of years. Well, it's nothing short of amazing.
Renegade Online.
Covered this on the show, the special show Thursday. I want to talk a little bit about Netflix here. Again, it's kind of a preview because we're moving into earnings season. So here's where we're at currently. Netflix, Friday, as expected, following the Thursday afternoon earnings release. Yeah, they blew up 11%. I think they were up as much as 12 or 13% in
Yeah, I noticed they had a bunch of new subscribers. Where'd these all come from all of a sudden?
I think they reported 5 million new subs in the quarter. Which is it's not huge for Netflix, but then again, they're almost at 300 million global.
That's what I mean. They've hit that ceiling, right, to where like even that big of a jump made me go, huh?
Yeah. Well, most of their expansion at this point, if it's going to happen, is going to happen in international markets.
That's what I was waiting for, was for you guys to report that they just opened up in some other country.
Well, I think they're mostly open, but they're adding more content. But here's the kicker, right? Apart from Netflix blowing up 12% following an earnings call. When's the last time you saw the Walt Disney Company blow up that much right after an earnings call? I can't remember. It's probably at least 3 or 4 years ago now. But here's the deal. You look at Netflix, and like I tell folks all the time, don't pay attention to the price of the stock. The price of the stock doesn't mean anything because one company might have 100 million shares outstanding. Another company might have 10 million shares outstanding. Don't look at the price of the stock, but you have to look at overall market cap. Market capitalization right now, as of the close of Friday, Netflix is a $328 billion, call it, company, according to investors, because that's what investors say that Netflix is worth by having its share price at $763 a share, given the number of outstanding shares that there are, okay? You can look at the average volume on Friday. Usually you'd have 3.2 million shares of Netflix traded on average in a day. On Friday, it was at 16 million. Very, very heavy trading day for Netflix, and for obvious reasons, and we see what happened, okay? $327 billion company. Here's the Walt Disney Company. $176 billion. So they are roughly one half of Netflix. The market thinks that the Walt Disney Company is worth half of Netflix. Now, why is that crazy? It's crazy because Netflix doesn't have $100 billion worth of real property, real estate, hotels, theme parks, actual physical real property. They don't have $100 billion of that sitting on the books. They don't have the theme park operations. They don't have ESPN. They don't have the 4, 5, 6 decades, whatever the hell it's been, of cable channels and linear broadcast. They don't have a broadcast network like ABC. But I want you to look at something. Hey, Valiant, is the market just overpricing Netflix? Or are they underpricing Disney? Let's see how those stack up. Here we go, kids. The price to earnings ratio. This is a PE ratio is one of those key metrics on Wall Street. PE ratio says the stock is priced at a certain factor of earnings, right? So in this case, the price of Disney at $97.28 is priced at 37.27 times the annual earnings per share. So it's PE ratio that's not way down in the single digits or low two digits, but it's not quite in the stratosphere like some things have been priced way beyond that before, right? What is Netflix? Maybe Netflix is really overpriced, right? Their price to earnings ratio maybe is really, really crazy. Maybe that's in the stratosphere. No. Netflix's price to earnings ratio is at 43.11. Just a few ticks higher than Disney. It's not 100. It's not 80. It's not 200, right? Price to earnings ratio. You want to see some crazy ones. I don't know if I think that's probably off the mark nowadays. Here we go. NVIDIA, right? Big dog NVIDIA. Now worth $3.385 trillion. They're worth 20 Walt Disney companies, okay? That's how big NVIDIA is. Their PE ratio is at 64.49, right? Meaning people have a lot of faith in the future trajectory of NVIDIA, that's going to actually happen, right? That's what that means. It's a bet on the future. The point here is that when you look at Netflix and you look at Disney, they're not terribly far apart in some of their most core basic measurements of financial performance of stock price compared to earnings, the PE ratio in this case. But here's where it really gets crazy. So how is it that Disney, with all of its assets, is worth roughly half of what Netflix is? Netflix at $328 billion, Disney at about $175 billion. Well, let's talk about that. This is Disney's earnings report that we covered back in August. Remember, the next one is in November, guys. November 17th, we've already got that set up. The live stream is up. In fact, I'll pull it up because more of you are still dropping, y'all are still dropping super chats and still dropping gifted memberships into that stream that we're still like 3 weeks away for, which is great. You guys are awesome. But I want you to pay attention to a couple of things here. Revenues for the quarter that ended on June 30th for Disney, right? Revenues for the quarter, won't let me highlight this, $23.2 billion, okay? $23.2 billion. They had an income before taxes of $3.1 billion. But this is what I want to look at. The earnings per share was $1.43. So for every share of stock, based on the stock price, you had a share of stock, your company, your share of stock earned $1.43. Now, that's not bad. Okay, there's companies out there that earn less than $1 a share because sometimes they have way more shares of stock, right? So it's all weighted. But earnings per share, $1.43 earnings per share, right? Remember what we said the market cap difference was between Disney and Netflix? Almost 2-1 in favor of Netflix. All right. Now, let me pull that down for a second. And this is what we talked about Wednesday. Well, let me call your attention to this. Okay. Total segment operating income, okay, for the 9 months ended 2024 was almost $12 billion. The quarter ended, total segment operating income, $4.2 billion. So $23 billion of total revenue for the Walt Disney Company, $4.2 billion in operating income, which is a profitability measurement, right? All right. Hang on to those numbers in your head. For those of you who didn't see me cover this Thursday, because I know not everybody watches the earnings call streams, especially if they're not Disney. Let me show you what Netflix is. And I got to expand this. I love the way Netflix does their reporting. They just give you a spreadsheet. Here we go. Here's Netflix. In the same period of time, we scroll over here to 2024, and we go to the quarter ended on June 30th, the same last quarter that Disney reported. Now, Netflix just reported a new quarter since then, but Netflix had total revenues of $9.5 billion right here, where my cursor is circling. $9.5 billion was the total revenues, right? They took home out of that operating income right there, $2.6 billion. Okay? So here's the deal. Disney is making more than twice as much. Top line, 9.5 to 23. Okay? And they're starting to approach being able to make, I'm thinking, close, probably within the next 2 years, I think Netflix is going to be taking home more profit than Disney on maybe half the revenue. So we're getting to that point now where it's ridiculous. Look at the most recent quarter here that they just reported. $9.8 billion in revenue. We don't know what Disney's revenue is yet. Probably expected to be in the 20 billion range again, like it typically is. But $9.8 billion with almost $3 billion in operating income. Now, you're talking about Netflix, who doesn't have nearly the risk exposure. Netflix, who doesn't have $100 billion of assets in the ground. Theme parks, hotels, actual physical real estate in California, in Orlando, in other places around the world where they have some type of ownership. Netflix has none of this. And the profit margins they're making are stupid. We're now going over 25% profit margin for Netflix. And they expect it to keep growing. They expect it to keep going. And this is kind of the big deal with Netflix. And again, when you look at the market capitalization of them versus Disney, and you have to start asking yourself right now, who does Wall Street have more faith in terms of being the future of the streaming space and the entertainment industry? Even though Netflix doesn't have the footprint Disney does with cruise ships and hotels and theme parks and everything else, but I should tell you right now that Wall Street is far more excited about the future of Netflix than they are about the future of Disney. That's just a fact.
Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.